Welcome back to The Deep Dive. We're here to unpack the latest earnings calls, giving you the key insights.
That's right. Today we're tackling a recent call where the company presented their full-year results for FY25.
And the headline up front was, results pretty much in line with what they'd guided.
Exactly. They confirmed they met their guidance for both adjusted EBITDA and adjusted free cash flow for FY25. So no major surprises there on the historical performance.
Okay, stable ground for FY25. So what's the plan, the outlook for FY26? And this was presented before factoring in the big UK merger, correct?
Correct. Pre-merger basis. For the group, they're guiding adjusted EBITDA between 11 and 11.3 billion euros.
Uh-huh.
And within that, the European segment target is 7.2 to 7.4 billion euros.
Right. And the cash flow, always a key number, adjusted free cash flow.
They're aiming for 2.6 to 2.8 billion euros. And interestingly, they really emphasized an expected acceleration in that adjusted free cash flow growth for FY26.
Acceleration. Okay, that sounds like it connects to the big transformation agenda they've had running for the last couple of years.
Absolutely. It's built around those three pillars: customers, simplicity, and growth.
And structurally, how has that simplicity part played out? We've seen some big moves.
Yeah, quite a bit of portfolio right-sizing. So selling off Spain and Italy.
Right.
The planned merger of Vodafone and 3UK is obviously central to that reshaping, plus further monetization of Vantage Towers, their infrastructure arm, and simplifying the ownership structure in India.
So it's been about focusing the business, streamlining things.
Exactly. And they argue the benefit is a reset capital structure, a much stronger balance sheet now. They've deleveraged quite significantly.
And that allows for?
Well, significant capital returns. They finished a 2 billion euro buyback after an Italy sale, paid out 1.8 billion in dividends last year.
Uh-huh.
And they've just started another 2 billion euro buyback. This one funded mainly from the Spain proceeds, so clearly returning cash to shareholders.
Okay, that's the financial engineering side. What about the customers pillar? Any tangible improvements they pointed to?
Yeah, they spent quite a bit of time on customer experience. They highlighted achieving best ever scores in some areas, particularly in the UK, claiming market-leading NPS Net Promoter Score and their lowest ever churn rates for both mobile and broadband there. Seems like real progress in the UK.
But Germany's still the tough spot, isn't it? I recall that being a focus.
Yes, definitely acknowledged more work is needed in Germany, but they did report progress there too. Said they delivered their best ever NPS results in Germany and halved the gap to the main competitor.
So moving in the right direction, but maybe slower.
Seems like it. Still a work in progress, as they put it.
They also mentioned becoming leaner. Efficiency drives.
Right. Part of that simplicity pillar, too, I suppose. They've actioned a plan for 10,000 role reductions across the group over time.
Wow, okay.
And implementing new commercial models, aiming for efficiency gains in shared operations, and accelerating productivity.
So putting all that together, the disposals, the streamlining, the customer focus, they're saying this positions them for future adjusted free cash flow growth. Where's that growth meant to come from?
Yeah, they're looking for sustainable FCF growth over the medium term. The breakdown they gave was roughly 2/3 from what they call their growth assets.
Okay, place is already doing well, presumably.
Exactly. And the other third, that's expected to come from the turnaround effort in Germany.
Germany again. That 1/3 is pretty crucial then. Let's dig into Germany a bit more. What are the specific headwinds they're facing there?
It's been tough. They mentioned the declining broadband base, which has been an issue. Then there's the huge MDU transition.
Right, the multi-dwelling unit legislation change. That affects cable particularly.
Massively complex. And on top of that, recently, significantly tougher competition in the mobile market. Pricing has gotten very aggressive.
So what are they doing about it in Germany?
Well, new management team in place. They've made specific investments in the network and customer experience. And they mentioned a large restructuring program there is nearing completion.
Any green shoots? Are they seeing results from these actions yet?
They say they are, in leading indicators at least. Reversing the decline in customer satisfaction, getting their best ever NPS scores in cable, and seeing loyalty benefits starting to come through.
Okay, so for FY26, specifically in Germany, what's the expectation? Still challenging.
Yes, challenging market conditions are expected to continue. But they think the results will get a boost from, well, first, a more stable customer base now. And second, crucially, the growing contribution from the one-in-one migration.
Oh, yes, the one-in-one deal.
Yep.
Bringing their customers onto the Vodafone network, How's that progressing?
Apparently, it started slow but has really picked up pace now. They expect it to be at its full run rate in the second half of FY26. So that's a keen driver for German revenue this year.
You mentioned the mobile competition. How bad is the pricing pressure? Is it hitting ARPU, average revenue per user?
Management was pretty blunt, actually. They expect mobile ARPU pressure to continue right through FY26 within their forecasts, driven by really aggressive price points, particularly mid to high end. They've responded by introducing new bundles with device financing included.
But the underlying issue remains.
Yes, and they were quite explicit, saying the current pricing situation is, quote, damaging for each and every one of us, meaning all the major players in Germany. That's strong language.
It really is.
Yeah.
So how does that square with expecting service revenue growth in Germany during FY26?
Well, despite that mobile pressure, the growth expectation relied heavily on that one and own contribution ramping up significantly through the year.
Oh, there you go.
They did note the broadband base has stabilized, which helps, but the TV business is still in structural decline, dragging things down a bit.
So if you strip out the one and own effect, is the core German business actually growing?
Yeah.
Or likely to in FY26?
Management suggested that organic growth, ex one and own, is pretty unlikely in the second half of FY26, given those pricing conditions.
Right.
And looking further out to FY27, they said growth would depend on market pricing improving, their own execution, and keeping that customer base stable. So it's fragile. The recovery story for Germany currently leans very heavily on one and own.
Okay, that puts Germany in perspective.
Yeah.
Let's pivot to the more positive side, the growth footprint, as they call it. Africa, Turkey, and increasingly the UK.
Yeah, much brighter picture there. The UK had a strong FY25 8% EBITDA growth. They kept highlighting the NPS leadership and record low churn rates there.
And the big catalyst for the UK is obviously the merger with Three.
Absolutely. They're positioning it as transformative. They're pumping significant capex into the UK this year, 1.5 billion euros in FY26 alone, mainly to accelerate the combined network build.
Huh?
They expect immediate benefits from combining the networks day one, better coverage, more capacity.
Yeah.
And they believe the merged entity is structurally set up for EBITDA and free cash flow growth even before synergies kick in.
And the synergy targets, still the same.
Yep, reconfirmed. 700 million euros annual cost and capex savings by year 5 post-merger, validated in the joint business plan. Plus, they expect extra revenue synergies, maybe from fixed wireless access, things like that.
And Africa and Turkey, still strong.
Very much so. Strong local positions, lots of growth opportunities beyond just basic connectivity. They made a point of saying they achieved hard currency growth ahead of inflation in those markets.
It's impressive in those environments.
Shows good pricing power and cost control. They also mentioned their Vodafone investments portfolio chipping in with dividends and holding potential for future value realization.
Going back to the UK merger, you mentioned it impacts the FY26 outlook, even on a pro forma basis.
Uh-huh.
How did that look?
Right. If you imagine the merged UK business existed for all of FY26, they expect it would contribute around 400 million euros to group EBITDA.
Okay, positive on the profit side.
But it would also be roughly a 200 million euro drag on adjusted free cash flow for the year.
A drag? Why is that?
It's down to upfront investments. That big network capex commitment we mentioned, integration costs to put the businesses together, and also covering the interest on Three UK's existing debt.
Got it. So near-term cash cost for longer-term gain. And that drag hits both adjusted FCF and full FCF.
Yes, they clarified that. No extra hidden costs below the adjusted FCF line. It's an important point for listeners. The merger boosts EBITDA potential, but comes with upfront cash demands.
Okay, let's switch focus to B2B, business to business. How's that segment performing?
Pretty well overall. Showed positive growth momentum through FY25, accelerating each quarter, and exited Q4 at 5.1% growth.
Right.
And they expect that good group level growth to continue into FY26.
Are there differences between markets and B2B?
Yeah, a few nuances. UK B2B actually declined in FY25.
Yeah.
Partly lower inflation impact compared to consumer, so less scope for price rises. And they flagged some challenges for UK B2B in FY26 too, losing some older, lower margin managed services contracts.
Okay, but elsewhere, what's driving the growth?
It's really the digital services side, so cloud, security, IoT things, beyond just selling phone lines and broadband to businesses.
Right, beyond connectivity.
Exactly. That's supplementing the lower growth in core connectivity. They're investing here, more salespeople, wider product range in digital services.
Any external factors helping B2B?
They did mention the geopolitical focus on sovereign technology and defense services as being supportive, creating opportunities, a bit of a tailwind.
And how big is B2B overall now for the group?
It's significant, approaching 30% of group service revenue.
Wow.
Margins might be slightly lower than pure connectivity, especially with digital services, but they stressed it's asset light, low capex intensity, uses partnerships well, and contributes positively to cash flow. Clearly a strategic growth area for them.
So tying it together, they seem pretty confident about those growth markets, Africa, Turkey, and the future UK business. What's the basis for that confidence?
Several things. Discipline in managing inflation, getting revenue up faster than costs, good execution on the ground, they claim, and just the sheer market potential.
Connectivity growth, population.
Yeah, plus data monetization. And they see these nonlinear growth opportunities, the digital services we just talked about, financial services, especially in Africa, maybe sovereign data centers. They also think there are group synergies, procurement scale, sharing best practices like AI from Europe to emerging markets, or digital techniques from Turkey back to Europe. The overall message is these growth areas are key to delivering that sustainable midterm adjusted free cash flow growth they keep talking about.
Okay, let's talk capital allocation, specifically the share buybacks. They've been pretty substantial.
Very substantial. 2 billion euros completed, another 2 billion underway now. The rationale given was basically value creation selling Spain and Italy unlocked cash and a strong belief that the shares are undervalued.
So accretion potential.
Exactly. They see it as accretive for remaining shareholders at current levels, a way to return capital and signal confidence.
They also flagged a specific metric linked to this, didn't they?
Yeah.
To emphasize the per share value.
Yes, they really pushed this one. Expected 17% year-on-year growth in adjusted free cash flow per share for FY26. Based on their guidance midpoint.
7%.
They feel the market isn't fully appreciating that metric and how the restructuring combined with the buybacks is designed to boost value on a per-share basis.
And a dividend.
It was rebased lower previously, as you know, but they stated an ambition to grow it again over time. And as a little signal, they mentioned the CFO had personally bought shares.
Right.
The current buyback runs through FY26, then they'll look at dividend levels again.
Okay. Now, during the Q&A, there was a push for more detailed, longer-term guidance like some competitors provide. How did they respond?
They acknowledged the request, didn't commit to anything specific, but said it's something they can now consider more seriously for the future.
Why not?
Because the major structural surgery on the group is largely done. The portfolio reshaping is mostly complete. So the argument is, now the focus can shift to demonstrating the growth from this new shape, potentially allowing for a clearer long-term outlook down the line. Watch this space, basically.
Speaking of watch this space, any more concrete update on the UK merger closing? Is it getting close?
Sounds like it. They said regulatory approvals are done, the joint business plan is locked down, and they're just working through the final customary closing adjustments. The exact phrase was, watch this space. So, imminent seems a fair guess.
Got it. There were also a few financial clarifications sought by analysts. Can we quickly run through those UK merger numbers first?
Sure. They confirmed the 400 million euro pro forma EBITDA contribution is based on Vodafone's accounting policies. Detailed reconciliation needs follow-up, and crucially, that 200 million euro FY26 FCF drag we discussed that includes the integration spend and capex, and it's the same figure whether you look at adjusted FCF or full FCF, no extra cash strain below the line.
Okay, and restructuring costs?
There's a moderate step up in cash spend for restructuring in FY26, partly UK integration, partly finishing off the German program. It's all part of a previously announced 5-year, 500 million euro plan, which is heavily front-loaded.
Right.
They did acknowledge an analyst's point about wanting better visibility on FCF after all these restructuring costs finally roll off, said it was a valid point for future consideration.
And the last clarification point was around the free cash flow breakdown slide and dividends from Vantage Towers.
Yeah, they said the market breakdown slide was simplified for the presentation, but assured analysts everything is attributed fairly, including dividends from Vodafone investments. On Vantage Towers, the 307 million dividend received was underpinned by Vantage's own performance growth. It also includes some contribution from a specific joint venture called Invit. Apparently, a special dividend is expected from Invit in FY26 too. They stress they are not over-distributing from Vantage or over-leveraging it. They expect similar dividend levels, around 300 million annually, from Vantage going forward.
Okay, so wrapping up the narrative they presented.
Yeah.
It feels like a story of post-surgery, recovery, and refocuses.
That's a good way to put it. 2 years of intense transformation reshaping the group. Now, the strategic focus is clearly on leveraging those growth assets, the UK, post-merger Africa, Turkey, while grinding out that turnaround in Germany.
And the operational stuff, customer experience improvements, efficiency drives, that's all meant to feed into the financial results.
Directly. Better CX means a more stable base, hopefully better revenue. Efficiency helps margins. It all flows towards supporting that improved adjusted free cash flow outlook they're guiding for FY26 and beyond.
With the UK merger positioned as the real game changer.
Absolutely. Framed as the key catalyst for accelerating growth and unlocking significant synergies down the road.
And B2B playing an increasingly important role.
Yes, particularly that digital services part, highlighted as valuable asset-light, good cash flow characteristics, a sort of new growth engine alongside traditional connectivity.
All aimed at delivering sustainable FCF growth and, crucially, boosting FCF per share.
That's the bottom line they're pushing. The buybacks, the rebased dividend with growth ambition, it's all framed around strengthening the balance sheet and driving shareholder value. With that 17% FCF per share growth forecast for FY26 being the key metric they want you to focus on.
Right. Now for our quick, not financial advice segment. Remember, this is purely hypothetical, based only on the color and specific comments from this earnings call. Do your own research, folks.
Okay, so based on management's very direct, repeated comments about the ongoing aggressive mobile pricing pressure in Germany.
The damaging for each and every one of us line.
Exactly. That strong language really stood out.
Yeah.
You could hypothetically build a tactical trade idea around that specific point.
Okay, let's hear it.
It might involve taking a tactical short position on a European telecom peer one you'd need to identify that has significant exposure specifically to the German mobile market.
The rationale being?
The rationale is, if a major player like Vodafone is explicitly forecasting continued ARPU pressure and calling the market dynamics damaging, it suggests that the pain might be felt across the board in that specific segment, maybe more than the market currently expects for other exposed players. It could delay recovery or squeeze profitability for others too.
Interesting. And you'd pair this short with?
You'd pair it with a long position, perhaps in a company or maybe a basket of companies that are focused on delivering high-growth digital services or B2B beyond connectivity solutions in Europe.
Ah, the old telco under pressure versus new telco services growth play.
Precisely. This long side is inspired directly by Vodafone's own positive commentary and investment focus on their B2B digital services, highlighting the attractive cash flow, the asset-light model, the lower capex intensity. It's a bet that the real structural growth and value creation in European telecoms right now might be shifting towards these adjacent enterprise and digital areas.
Which are less exposed to those brutal consumer mobile price wars like the one described in Germany.
Exactly. It's a divergence bet, hypothesizing that the German mobile legacy business could be a drag, while B2B digital services offer a path to growth. Strictly based on the nuances we picked up from this specific call, of course.
Of course. Fascinating idea, but absolutely 100%. Not financial advice, just connecting the dots from what was said.
So to quickly recap the main takeaways from our deep dive into this call. FY25 results were in line. The major transformation efforts of the last 2 years have reshaped the group. The focus now is squarely on FY26 growth.
And that growth story really relies on 3 key things. The big UK merger, closing and delivering, continued strong performance from the growth footprint markets like Africa and Turkey, and successfully executing the turnaround in the challenging German market.
And the core message to investors underpinning all of this is the commitment to sustainable medium-term adjusted free cash flow growth, with a particular emphasis on driving up adjusted free cash flow per share, helped significantly by those ongoing share buybacks.
Okay, that wraps up our analysis. As always, remember, this summary is for informational purposes only. It is definitely not financial advice. Earnings calls provide useful insights, but they're only one part of the picture.
We encourage you to do your own homework. Maybe think about how those specific market dynamics in Germany could ripple outwards, or where those beyond connectivity growth opportunities really lie.
Thanks for joining us on The Deep Dive.